Hello everyone, welcome to Accounting 312. In this video, we will talk about Chapter 13, Pricing Decision and the Cost Management. So basically, there is just one word for this chapter. The word is pricing. Remember, we said we did some decision making before. So in this chapter, the focus on how do you decide the selling price or the price you want to charge from your customers about your service, about your products. So before we go to the detail, I want to ask you a question first, and you think about it, pause the video for 1 or 2 minutes. Have you ever sold things like you at eBay or Amazon, Craigslist, to your cousin, sisters, boyfriend, girlfriend? So if you have ever sold anything, no matter it's a used car or used textbook, or any other things, how did you price your products? Like, let's say, hey, I think I sold a car. I sold one used car at Craigslist. So if you sold used cars, how did you decide you want to sell the car at 3,000 or 4,000 or 5,000 or 1,000? I want to let you think about that situation because that may help you to learn this chapter. So in this chapter, we will be managers. We want to find out how do we decide the pricing for our company. So as always, the first part is always some background. Before we go to talk about the calculation, you want to know there are three factors. There are three factors affecting pricing decisions. There are three factors. So textbook said, if you learned other class, you should know it's definitely just the demand and the supply, right? Demand and supply. So there is demand curve and supply curve. I'm not sure which one is which. So I believe this is the supply curve. So this is dollar, this is the units. Higher you will supply more. So this is the supply curve, and then this is the demand curve, right? So if it's higher, your demand will decrease. So that will be the price. But how do we specific those three factors? What will affect the demand and the supply? So the first, we call it the three C's because all these three words, they start with the letter C. Think about this. Pause the video, think about what will affect the demand and the supply. So you have what? You have a cost. You have a cost, right? Then you also have what? You also have competitors, right? Competition, and then what else? You also have customers, right? You also have customers. So those three things, they will affect the demand and the supply, which will eventually affect our selling price. So how do they affect which line? Cost will affect your supply, right? Because if it's too expensive for the material, for the labor, then there will be less supply. And the customer will affect your demand, right? If you have more customer, the demand will be high, so you can sell at a higher price. And then with the competition, it's just in the middle, it affects both supply and then the demand. I would say read textbook. Remember, we talked about this in chapter 14, chapter 13, chapter 12. Our handout is directly related with your textbook. So I would suggest you read textbook. Okay, read textbook. Managers, we should weigh the three factors based on the market. Why? If the market is very competitive, let's say you sell this pen, Walmart also sells this pen, Target also sells this pen. So if the market is very competitive, you cannot decide the price. Let's say, hey, Walmart sells this pen at $1. If you sell at $2, and nobody will buy it from you. They just go to Walmart. So the price is already decided by the market. The only thing you can do is you control for the cost, right? You have more efficiency, you have better technology, you control for the cost so you can earn money. Okay, so when it's very competitive, the cost is very important because that's the only thing you can control. But if there is no competition, we just kind of like a monopoly situation. You are the only one. You are the king. You are the queen in the market, right? So let's say I'm just making up an example. It's definitely not right to do. I say I want to sell your exam questions. So there is no other suppliers. I'm the only one, so I can charge as much as the customer wants to pay. So the main thing I care is the customer. Hey, if the customers are happy, they can pay me $1 million maybe. So when there is no competition, customers are more important. So those are just the background. As I said, I would say read textbook, get these parts. You may have a multiple choice. So it's really not hard. Read textbook, you will get it. Go to next page. Go to next page. Um, Costing and pricing for the long term. Remember when we did chapter 11 or chapter 10? I don't remember. Let's say we talked about relevant information, right? I don't remember chapter 11 or chapter 10. I'm bad. We talk about for the short term. Remember one-time special order? We said, hey, what's the minimum price for one-time special order? Only focus on relevant cost. But when we talk about long run, when we talk about long term in chapter 13, we have to cover all the cost. We have to cover all the cost. Because it's a strategic decision to build a long-term relationship. You want to have a stable price so that you can have a better interest after 3 or 5 years. So kind of read those words, get general idea, just know short term, focus on relevant information. Long term, we have to cover all the cost because in the long term, everything is relevant. And we also want to earn some money, right? You don't want to say, hey, I'll work so hard and just break even, get 0, 0, 0 every year. That doesn't make sense. So you have to cover all the cost and earn some profit. Basically, that's what they said. It's only worth to if you cover all the cost, and then you also earn some return, which is also your profit. So look at this question. I'll work this one with you. You manufacture coffee. I want you to post maybe, right? So you get the answer first, but you also help me produce these. You have all these for long-term price you want to make. Our return is 20%. So markup is basically just the profit that you want to earn. You mark up 20% based on the full cost. So what is so your first question is the full cost, right? We have to cover the full cost. So the full cost will be direct labor, direct all of this. Okay, so all of this is our in the long term, we have to cover all the costs. In the short term, we just think about avoidable, will be relevant, not avoidable, not relevant. But now full cost. So if you add everything together, it's 176.75. You say, oh, I got the answer. Answer is say 167.7. Oh my goodness, I got 4 points. Is that right? Yes or no? No, that's not right. He said, why not right? Because you have to add the profit. You want to have 20% of your full cost, 167.75. So you want to get that as the profit. So your total has to be answer D, $201.3. So that gives you 201.3 as your long-term selling price. Okay. So answer C just covers the full cost, but you don't earn money. In the long term, you have to earn some money. Any question? If no question, I go to next slide. Purpose of cost allocation. We have been talking about cost allocation in chapter 14, I believe. We said whether we should allocate those like division level cost and then the channel level cost to customer. Remember that one? Oh, we didn't talk about purpose. We talk about the 4 criteria. Make sure you go back to that chapter and then think about those 4 criteria. But now there are also 4 reasons for purpose of a cost allocation. So why in the long term we have to cover even the fixed cost, even cover the unavoidable, why we have to allocate cost? Because it provides information for economic decision, and then it also motivates managers, and then maybe salesperson and then other employee to, control for the waste, improve the efficiency. It also justifies cost to compute the reimbursement amount. The textbook probably said it's related if when do business with government. If you want to get reimbursement, you don't just want to get reimbursement for the short term, for the like just the relevance in the, let's say I'm a consulting firm like a CPA. I don't just the money I want to get from my customer is not just pure labor. I also need to allocate some of the rent, some of the utility to that client, right? So you want to get reimbursement to cover all of the cost. And then also we have to use that information for our income and asset. So get some idea. I may, as I may test you in the exam. So read textbook and then also try to practice some multiple choice in a more practice packet. So now we finally go to talk about the main part of chapter 13. We said chapter 13 talking about pricing. So there are 2 alternative approaches for the long-term pricing based on the market. So if the market is very competitive, we already talked about that, you cannot really decide the price. All you can do is you control for the cost, right? You control for the cost, so you can get some money. The other situation in that situation is called a market-based approach. So market already decided the price for you. All you can do is, given what our customers want and how competitors will react to what we do, what price should we charge. So market and competitors, they already decided for you. The other situation is a less competitive market. As I said, if I sell the questions to you, it's less competitive. All I care is about the customers. Then I can charge you whatever I want to cover the cost and then also get some profit. So that situation, we use a cost-based approach. We can cover the cost and then we also add some profit. Given what it costs us to make the product, what price should we charge, so we can cover all the costs and then we can also earn some money. Okay, so let's go ahead and do each one. Market-based approach. I'm not going to really read about general idea. Is, as I say, you don't decide the price. Market already decided for you. So what can you do, right? What can you do? So let's say you go around, you find out, hey, people like this highlighter, like this pen. So you say, okay, then I will also sell this thing because it may earn money. So your first thing is you have to find a product that satisfies the need of your potential customers. So if you learn some marketing management classes, you can do this. You can find the customers' demand by doing survey. You ask your friend, hey, what color you like, what design you like. Then finally you decided, hey, people like this yellow one, so you will do the yellow one. And the next step is you found out the target price. You found out the target price that your customers are willing to pay. So you go around, you find the target sales at $2, Walmart sales at $2, So you're thinking about, to be competitive, maybe I just sell it at like $1.9 or $1.95, $1.99, And then next step is kind of important. So we have a keyword called derive a target cost. We derive a target cost by subtracting from your target price and with your target operating income. So that will be your target cost. Then we do value engineering to achieve our target cost. We do value engineering to achieve our target cost. You will say, not sure what we are talking about. So we look at an example. Okay, so the company needs to earn 10% of the operating income. So they want to earn 10% of your revenue as the income based on the units you are going to sell. Selling price is this, and then the units you are going to sell is this. So our total revenue will be easy, right? So the units you are going to sell is 200,000, and selling price is $800 each. So our targeted revenue will be $160 million. And targeted operating income, we said our operating income will be 10% of the revenue. So 10% of our 160 million will be 16 million as our total operating income. But it's out of 200,000 units, right? So for each one will be my 16 million divided by 200,000 units. So each one I want to earn how much? Each one I want to earn $80. I want to earn $80 as my target operating income. The next question is, what is our target cost? So remember, we talk about you have to derive the target cost per unit by subtracting the target operating income per unit from your target selling price. Sorry. So our target operating income, you always have to derive it. It's always your revenue, and then we said minus your cost gives you operating income. But when we do the market-based approach, we don't really know the cost. We have to derive it. Our revenue, our selling price, we just use selling price for each one, is $800 each, right? So we know we can only sell at $800 because if you sell at 801, customers will buy from other people. They can buy from Target, Walmart. Market already set the price for you. Market said highest price you can charge is $800. So we know the selling price. And we want to get $80. We want to get $80. Oh, this is so easy. Why I do this and do so many extra steps? 10% of your selling price will be your operating income. Oh, ours done. Okay. Anyway, so we said 10% will be your operating income. So you derive your cost. You can only control for the cost, right? So you said in order to do that, I have to control my cost at $720. My selling price is $800. I want to earn $80. So the highest cost I can afford is $720. If the cost is $730, you will only earn $70. That's not enough. But if it's $710, you will earn $90. That's very nice, right? So that's our third step. We derive the target cost. Our target cost is $720. So if we are 710, that means we are perfect. We don't need to do anything. We are above the the expectation. But if our current cost is 730, let's say our current cost is 730, then that will not work, right? Our minimum, the maximum we can afford is 720, but if it's 730, you only get $70. So what you can do, you have to do value engineering. You have to do value engineering to decrease your cost. You have to do value engineering to decrease your cost. So look at this company. They found out that the current total cost is $900. The total cost is $900. We compare our current. So our current is $900. Our target is 720. So our current is more than our target. Should we do value engineering? Yes or no? You tell me. I want to hear the answer. Yes, right? We have to do value engineering. How do we do value engineering? I'll see you in the next video.